2023. Yeah, we are recording. Thank you. And we are recording today because I really want to share this information with you guys here. Anyone who's not able to jump on the call and be part of the call today, definitely want to be able to share this with you. Part of sharing that with you is also the link that I put in the chat, and then Alfredo, you can share that with your team as well. And then that is my slide deck, essentially, which is all online. You'll be able to watch that now live as we go through it if you want to, if you've, we're on your mobile and if you can't see it very well, or you can review back to it a later time. You'll have view only access to that anytime you want. Now, as we go through, you might have some questions. If you do have questions, that's great. The only thing that I ask with questions is if you can keep your questions fairly generic, and not specific to a specific situation. And then that by having generic questions, it kind of allows everyone to share in it, and it's not like specific things, right? And then if you're not sure, go ahead and ask it, and I'll just say, hey, it's a little bit specific. I'll try to generic it a little bit if I can, and then if I can't, we can schedule a call later, or if you want to stay after, we might be able to facilitate that. Okay, so that being said, I guess I can go ahead and share my screen. Hey there, Sandeep. Good to see Sandeep always. Let's see here. Hey, man. Always good to see you, my friend. Sharing my screen. Number 2, here I am. Okay, so does that... Everyone can see that okay?
Yep, we got it.
Awesome. All right. Okay, so like I was introduced, Jake Adams, CPA. I've been a CPA for almost 10 years now, focused really on real estate agents, how real estate agents get taxed, how they can save money on taxes, real estate transactions like capital gains, as it was mentioned. But really, my goal and focus is to make taxes as easy as I can for agents, because most agents, like, you're just busy doing what you're doing. You're out there trying to sell houses, and let me kind of do the back end work, which is the bookkeeping and the expense categorization. Let me help you with taxes, things like that. That's really my goal and focus, is for you to do what you do so you can do what you do better. I've done lots of presentations for Bay East real estate agents, saving my clients a lot of money, like to save money on taxes and all that other stuff, right? So we can skip through that. We talked about questions. All right, so let's talk quickly about taxes and do an overview. And if you've been doing taxes for 10, 20 years and you already know this stuff, if you're a new agent, this is kind of important for new agents. But what I'm going to do is take like a 30,000 foot view and then dive down deeper. So what is taxes and how are taxes generated? Why do we pay taxes? How are we paying taxes? How do we figure what that is? So essentially what happens is you start at the top, which is your revenue, which is your net commissions. So how many houses you sold, your commissions, things like that. And then you're going to start taking away expenses. And then what happens is you're taxed on your net income, which is your revenue or your commissions minus all of your expenses. So what are expenses for agents? Well, you've got your auto, you're driving around a lot. There's a couple different ways to take your automobile. You could have multiple automobiles if you want to do that. You're probably spending money on advertising. I hope you are, and I hope that's growing your business. You're probably spending money on contractors and stagers and repairs and cleanups and things like that. So yeah, you're going through and you're spending money on your business. So the key to saving money on your taxes is knowing what these expenses are, having them in places where you can quickly get them, right? Which is like a credit card, a debit card. If you're spending cash for everything, it's very difficult at the end of the year to remember, hey, I spent $300 on, Javier, and he cleaned up the yard or whatever at a listing, right? It's very difficult if that happens in February to remember that 12 months later in February for your taxes. So keeping track of these things, paying by Venmo, paying by PayPal, Cash Apps, things like that, keeping track of them and knowing where to get that information when it comes tax time right now is super critical, because if you miss out on $1,000 of deductions, that's going to cost you a couple $100 in taxes. So maximizing the deductions is critical. So what is a business deduction? A business deduction is essentially anything that you need to spend money on to run your business. So if you're spending money on client gifts, yes. If you're spending on client entertainment, client meals, client, if you're, sharing money or having repairs done or things like that, right? Anything that's helping you run your business. If you need a new computer, if you need, new desk, office furniture, pretty much anything that you need to run your business, that is going to be deductible. Again, you need to keep that in a place where you have that so that you can go back tax time right now from last year, get all those together so you know where your expenses are and how much you spent on that money. Now, a lot of people ask me, well, Jake, that's great, but what about personal expenses? So whenever you can convert a personal expense to a business expense, it's going to help you save money on taxes, because instead of earning money and then paying taxes on it, you're earning the money and then getting a business deduction for it. So there's a big spread there. Sometimes for some people, it's 40 to 60%. So imagine going out and buying a new computer. Let's say it's $1,000 computer, and you get 60% off that computer because of the tax difference, because it's, instead of a personal computer, it's a business computer, right? So that $1,000 computer, if you purchase it for personal, it costs you $1,400 because you have to pay taxes on that $1,000 of income before you buy it. If it's a business computer, then it's only cost you $600 because you get a tax deduction for it. So that spread of, what is that, for $800 is the tax difference between having something for personal versus business. So again, anything that you would normally use for personal, cell phones, computers, office supplies, things like that, those are all going to be business instead of personal, and that's where you're going to maximize those deductions. As we talked about before the call started, trips, right? So maximizing trips is a great way of switching this from a personal expense to a business expense, because you can say, hey, I want to go to Vegas in March, right? Let's say. So instead of going to Vegas in March for a personal trip, can you make it a business trip? How do you do that? So essentially, how you do that is you want to say, well, what can I do while I'm there that's business related? And when I say business related, I mean, it's going to help you generate more business in the future. So for example, let's say you're in real estate, right? And so you can meet with other agents as a referral agent. I'm pretty sure that there's people that are moving out of the Bay Area to Las Vegas, or vice versa. So if you meet other agents, you can say, hey, I'd like to set up a referral relationship with you, so that if I have any sellers that are looking at selling out of the Bay Area and moving to Vegas, I want to be able to refer that client to you. That's great. Have that over coffee or lunch or something like that, and there you go. You're creating those business situations inside that trip where you're going to be able to make that tax deductible. Rental real estate, Airbnbs. What's going on with short-term rentals, long-term rentals, those kind of things inside that market? If you drive around with an agent, with a broker, with anyone that's familiar with the area, what's happening is the more time that you're spending doing those business related things during that trip, you're increasing the number of minutes to the number of hours that you need to be able to deduct that trip. If you're like, hey, I was going to probably do that anyway, or hey, let me throw a couple hours doing that anyway so I can make the trip totally deductible, well, there you go, right? And a lot of us really enjoy what we do, and like the status of markets and how markets are changing and things like that. So if you could spend some time with an expert learning about what's going on, it's going to help you, and you'll also be able to get the tax deduction for it as well, right? So you might even look at some current rentals, right? Or some current sales, or some current things on the market. You might say, hey, if we buy this place that's $500,000, what would the Airbnb fees be, or VRBO, or short-term rental, or long-term rental, or flipping it, things like that, right? So if you have a goal of making a business or earning more money from that time that you're spending, that's what the IRS wants to see when it comes to that deduction. So what are the time limits for that? I mentioned spending time during a trip. Well, when you're doing a domestic trip, which is anywhere here in the US, it's 51% business over the course of the days, right? So if it's a 5-day trip, then there has to be 3 days. It has to be majority time spent for the business. So a 5-day trip, you'd have to do 3 days. And then an 8-hour day, you have to do 51% of that. So it'd be 4 hours. So essentially spending 4 hours over 3 days over a 5-day trip makes that deductible. And of course, I'm not going to go through all the situations, but you can kind of see where I'm going with that, where I'm leading with that. So you can say, hey, how do I make this tax deductible? And, there's really no limit to that. The IRS does have some limits to what they call extravagant or luxury things like that. So, if you're going out for a $500 dinner, they may ask, why did you have to go for a $500 dinner versus a $5 dinner, right? So they may have some questions with that if you ever get audited, but of course, knock on wood, you don't ever get audited. Just keep track of your receipts and make sure that you record who, what, where, when, why, and how. So if you did take someone out to a $500 dinner, who was that person? Why did you do that? Do you have, some sort of goal where, there's some sort of business opportunity in the future that you felt like it was a good idea to spend $500 on a meal with someone, right? So that makes sense. Now, how does that compare to international travel? Well, international travel is based on the percentage, not all or none, right? So I mentioned with the US, it has to be a majority of the time. So a 5-day trip, 3 days, 4 hours per day. And then you get all the trip deductible. So international is different because it says, hey, you can do an international trip, and maybe it's maybe you go to China and you're doing personal stuff for 5 days and then business stuff for 7 days, right? So they're not going to say, well, you can't deduct the whole thing because it was more personal or more business. You only deduct the percentage based on what was business. So they're totally okay with you doing some personal stuff, some personal travel while you're international. And of course, I'm not going to go through all the examples and all the scenarios, but you can kind of kind of figure out where I'm going with that. You can decide how much of that trip you wanted to deduct with your tax person, either during the year or come tax season. Okay. So before I move on, is there any questions about kind of the general overview of taxes, or what is a deduction, or business trips? Just kind of open it up if anyone's got any questions. You can put in the chat.
Oh, I have a question. Can you hear me?
Yeah.
Oh, okay. My name is Monique. I'm Lady M over here. So my question is, when we document, or say like you mentioned about Vegas, 5-day trip, 3-day work, do we have to fill out some type of form? I know you said keep receipts, but is it like an expense report we put down? Like, okay, today, like say March 10th, meeting with agent such and such. Is there like an expense report we fill out?
Yeah, so there's no specific form, right? But the IRS is going to want you to keep a diary or a log or some sort of transaction list. So just like you said, is if you do go out for a meal with someone, they're going to want to know who, what, where, when, why, and how. So as long as you have something that documents those 5 things about and then you got to do that for mileage, right? For auto use. So if you drove from, X to Y, you need to document that I drove from X to Y, and who you did that drive for, or what you did that drive for, and what was the business reason for that. So yeah, I mean, every single agent needs to be keeping some sort of log or diary or whatever you want to call that, not only for every mile that you drive, but also for every dollar that you spend in the business. So you need to know at all times why you're doing that. And a lot of agents don't do that. They're just kind of like, hey, I hope I don't get audited, and if I do, maybe I'll be able to recreate some of that stuff. But some of the best agents are keeping track of that stuff throughout the year, because it's fresh in their mind, and it's better to do that while you're actually doing the transaction versus waiting until a year later when your taxes are due, or 3 years later if you ever get audited on it. Then then you're like, I can't even remember what I spent that $20 on, which is completely different, right?
Yes, thank you so much.
Yeah, you're welcome. We got a question from Ram. For international trip, what are the usual deductible and what type of documentation? Yeah, pretty much anything that's business related while you're on your trip, right? So you got your airfare, your hotels, rental car, meals. You can even deduct cleaning of your clothes, dry cleaning, shoe shines, tips, baggage porter fees, all that, those kind of tips and stuff like that. So pretty much anything you're going to be spending during the trip, and then again for business related. So if you're wearing a suit and you've got to have it dry cleaned because you're doing a presentation, it's got to look nice. Well, of course, then that would then be deductible as part of the trip and travel. Okay. All right. So let's move on. We're going to have some other talks about the deductions, right? That a lot of the agents are asking about and should know about. One of the big things that I really have a problem with the IRS is gifts, right? They have not changed the gift limit, which is $25 per family in decades, right? So I really think that they should up this. They don't. I don't know why they're sticking their heels in it. But essentially, you need to make sure that you know about this gift limit, because if you are giving gifts to clients, which of course you should be doing, you need to know that there's that $25 limit. So how do you get away from that $25 limit, or how do you get more than that? Well, then it has to be a marketing expense. You might have heard Cutco knives and those and things like that that say, oh, well, it's marketing because it's got your name on it. Yeah, I mean, there's different interpretations, but essentially what you want to do is you want to be able to say, if you want to give someone more than $25 as for a gift, for a closing gift or something like that, we need to mark it as advertising or marketing. And then you have to have a conversation with your tax professional as far as what they feel comfortable with as far as deducting something as advertising and marketing versus a gift, right? And usually advertising and marketing have some sort of future benefit, right? Versus a gift, which is a past benefit, which is, hey, thank you for, XYZ, and here's your gift, right? Or you didn't do anything for me, here's your gift, right? Completely, whenever you give the gift, there's nothing reciprocal in back, or you never expect to get anything back in return. You're just like, hey, here's a $25 gift card for Starbucks, right? I'm done with it. But advertising marketing usually have some sort of like future benefit. So if you're doing something like movie nights and things like that, which I've seen some real estate agents do, those are good for advertising marketing, because you're getting a group of people and you're saying, hey, we're talking about the state of the market, right? These are the houses that are currently available for sale, or these are the ones that have been sold, or here's how the market's been changing up and down. You're doing a presentation. And so if you can get a group of people together and you're doing some presentation like that, that's always going to be advertising and marketing versus just like, a $25 gift card. It's more like gifts, if that makes sense. So it's constantly thinking about, okay, if I do spend this money on my business, number one is this going to give me a positive ROI? Because you always want to make sure you're making money with your money in business, but then also the tax ramifications and repercussions for that. Know that entertainment has been disallowed. So a couple years ago, they allowed us to do entertainment, which is, hey, I'm going to take my client out to a Warriors game, right? You'd be able to deduct that whole entertainment. That's gone away. They can't do that anymore, but you can now do food. So what a lot of like luxury sports boxes are doing is saying that the sports box is like free if you spend, $500 worth of food or something like that, right? And they're essentially baking the cost of the sports box into the food cost, right? So if you do take a client out to a Warriors game and you're like, hey, the Warriors tickets are not deductible, the parking is, tickets aren't, but the food is, right? So essentially, if you take, like a Warriors game or something like that, the parking's deductible and the food is deductible, but the tickets themselves are not. Remember that. However, if you give someone tickets and you're like, hey, let's say you do a giveaway or a raffle, right? So let's say you have a farm network and you're like, hey, if you answer this question and enter this raffle, you can enter a raffle for Warriors tickets. Well, now that's advertising or marketing, right? Because you did a raffle to try to build up more business. So then those would be 100% deductible. But if you just gave someone as a gift and said, hey, here's a gift for you, maybe you want to work with me sometime down the road, maybe you don't, but you're not collecting any of their information for marketing in the future, then it would be a gift that would be limited to $25. So it's really interesting to see how, something as simple as like Warriors tickets really depend on, are you going? Are you gifting it? Is it part of a raffle? And the way that you give those tickets away or present those tickets to somebody, and then what that person is in the future for you depends on how it's going to be taxed, right? So you can see how complicated this gets. So you want to know that you want to be having these kind of conversations with your tax professional throughout the year, because it's really important that the taxability of these things, they know the taxability of these things, because if you're having these conversations with your tax person in February, well, they're super busy doing taxes, right? You just don't have the time to do that. So this is really, really important. Okay. Meals are now 100% deductible if they're done in a restaurant. basically all meals are done in a restaurant. So just throw 100% to everything. And then also you need to know if you pay any contractors over $600 per year, that's with a cash or with a check, make sure you do a form 1099 NEC, which is the non-employee contractor form. That's a new form 2 years ago. And then if you're not sure about those, you can ask me any questions. Also, if you go to my website, adamsabc.com/1099, I've got some general Q&As as far as how to do those and where to do those. IRS was supposed to have a new portal this year where you could go on and you could file those for free. I don't know exactly where they were with that. They were just like rolling it out mid-January, which is ridiculous for something that is due at the end of January. So if you haven't done those are technically late, but the IRS is pretty forgiving with those. So I haven't seen anybody get a notice or penalties or anything like that for filing those late. So if you haven't filed them, just go ahead and do that. Like I said, lots of information. So if you need to file those, there's a lot of websites online. You can do that, tax1099.com. You can just go do a Google search for filing 1099s. You want to make sure you do those electronically because they're so much easier to just type in the information. You spend like, I don't know, $5-10. They'll e-file them for you and you just don't even worry about it. If you go and get the paper forms from like Office Depot or anywhere like that, you've got to get the special red form, the 1096 form. You end up filling out like 4 or 5 forms. You've got to mail them to 3 different places. It's just it's a headache. So in my opinion, it's a lot easier. Spend a couple bucks and just do it on the 1099. Just do it through a website. Rabina asks, is this $600 for per contractor or total for the contractors for the year? So it's per contractor. So if you pay, Jose for landscaping and garden cleanup, if you pay him $500 throughout the year, then there's no 1099. But if you pay him $1,000, then throughout the year, then you would have to do a 1099 for him. And then again, that's only if it's cash or check. Usually the Venmos and the PayPals, they'll take care of the 1099s on their side. If you want to make sure that you're, kind of doing everything that you should be for a business owner with the IRS, you can probably just do it just to be on the safe side. But a lot of times like PayPal or Venmo, people were like, don't even worry about it because, the Venmo and the PayPals, they'll take care of the 1099 for you. Contractors remodeling the house for clients. That's a good question. So if you are paying the contractors and then the client is going to be reimbursing you and then you get that reimbursement through the closing process through title or escrow or whatever, then yes, you are responsible for doing the 1099s. If you are not making the payment to those contractors, then you do not have to do the 1099. That's a really good question because a lot of people do run into that thing. So along that lines, what about stagers? If you pay the stager directly, then yes, you would have to 1099. If the stager gets paid through title or escrow at the close, then you do not have to 1099 because then the stager will get paid through title and escrow. They'll take care of the 1099. Okay. Really good things to know when that comes to that. All right, so I don't see any more questions, so let's go ahead and keep rolling out. Into vehicles, rolling out, look at that pun. So I always get this question a lot. Should an agent buy or lease a vehicle, right? And the thing is it's really different for everybody. Some people like to buy a car and hold it for a number of years. Some people like to lease a car and get something new every year. So really the personal preference is up to you. And I don't always recommend to go out and buy a certain type of vehicle just because you're going to get a tax deduction for it. Because you should get what you want and what you think is best for you. For example, I know a couple of people that work on the multi-million-dollar listings, the $5 million plus, and they want to be rolling out in McLarens or Mercedes or things like that. Well, those aren't really, there's no huge tax benefits for those, right? So if you want to be driving McLaren, like just drive McLaren, you're going to get a little bit of tax deduction for it, but it's more for the status that you want and for what you want to show and what you want to have and what you want to drive versus the tax deductions for it. So I mentioned that because you may or may not know this, but a real estate agent or really any business owner can purchase a truck or a heavy SUV and write off most of it, right? So some agents hear that and they're like, oh, well, let me go out and buy a heavy SUV and I'm going to or a truck or something like that, and I'm just going to use that for business because I'm going to save a lot of money on taxes. Well, you can do that, but if those are gas guzzlers, and if gas prices go up, which they have, then you're going to be spending more on gas, right? Or maybe you are unhappy with that because you want something more fuel efficient, or you want something sportier, or you convertible or something like that, right? So I say that specifically so that you understand that there are tax deductions for certain types of vehicles like trucks and heavy SUVs, but you don't like go out and buy a truck or heavy SUV just for the tax benefit. Make sure that it fits what you want and the vehicle that you want, and don't just buy something just for the tax deduction for it. That being said, the bonus depreciation for those types of vehicles have gone down. In previous years, we were allowed up to 100% of the business use. They've dropped that down to 80% for 2023. So if you do want to get a truck or a heavy SUV, just know that the deduction for that has gone down from 100% to 80%. Now, does that mean don't do that because you're getting less of a deduction? Well, no. I mean, it's still a great deduction. You're still deducting 80% of the vehicle. So if you buy an $80,000 vehicle and you use it for half for business, right? $40,000 deduction, 80%, that like 32K, 34K, basically you're creating a deduction of $32,000 or $34,000 just by buying this vehicle and using it in your business, which is great. Especially if you're earning over six figures, or if you have six figures of net income, being able to write off $50,000 or $100,000 of a vehicle and, almost completely wiping out your taxes is amazing, right? A lot of people really like that. And a lot of people think that that's really cool. And it is, right? Just know that there are some downsides. And it's not for everybody, right? Just make sure that it fits what you want and how you want to do it. And a lot of agents that are just getting started out, they'll do their taxes for the first year, and they won't know that there's a difference between the standard mileage and the actual expenses. And if they go to the tax person like H&R Block or TurboTax or something like that, it'll just say enter your miles for the year. And they're like, I don't know, I haven't been keeping track of miles. Maybe I drove 12,000 miles. So they type in 12,000, right? So what happens if you're not keeping track of your actual vehicle expenses and you just type in miles and let the software or the inexperienced tax preparer just put you to standard mileage? More than likely, you're going to be missing out on some deductions because the standard mileage is based on a Toyota Camry that's driven in like Nebraska, Kansas, or Arkansas. So the gas there is cheaper, the insurance there is cheaper, the maintenance there is cheaper, right? Everything in California is more expensive. So when you're using the actual expenses, especially with a luxury vehicle, and especially in California, you're going to be able to match what you actually spent on your vehicle for business use, driving around for your business, versus the standard, which is easier, but it's usually not as beneficial. So make sure you're looking at that. You can sometimes change back and forth, but make sure that you are talking with your tax preparer or fully understand what happens and the repercussions of switching from standard to actual or actual to standard. And then also make sure that you're putting those on a credit card or a debit card or something like that, so you can keep track of all those. If you're paying gas, or if you're buying gas with cash, not a great idea to do actual, because you have to keep the little the little receipt things that come out of the gas pump. Not all gas pumps do that. Sometimes it's late, sometimes they're out of things, whatever, right? So yeah, if you're using a credit card or debit card for gas purchases, that's better because you can keep track of those throughout the year. Okay. And then I'll touch one more thing and then I'll jump into the question. So I have right here, goal is to maximize the business miles. So what does that mean? Well, that means essentially if you're going to be driving around, make sure to drive around with business intent. So if you've got to drive from, let's say Castro Valley to Dublin, why is there a listing in Castro Valley that you can look at? Is there someone in Castro Valley you can meet with for coffee? Is there something business related that you can do so you can make that drive a business drive versus a personal drive? And again, that goes back to the business versus personal expenses before. Everything you can convert from personal to business is going to save you a lot, right? It's going to save you more money on taxes. So a good way of doing this is to take the office and home deduction. Now, a lot of people get bad advice, either from TikTok or the internet or from inexperienced tax preparers. And a lot of times they'll say, hey, don't take the office and home because it's a red flag from the IRS. So I'm here to officially tell you that that is the furthest from the truth that you'll ever hear, because the IRS has what's called a safe harbor for office and home, which means they say you can have an office and home. We're going to give you $5 per square foot of office and home, which means basically when there's a safe harbor, that means they're not going to audit that, right? They're saying, we understand people have office and home. We're going to be, allow you to be flexible with that. We're going to allow you to use it. So please take the office and home, right? And then what happens as real estate agents, when you do the office and home, that means that every drive that you do from your house to a business location is now a business drive. So before, if you don't have the office and home, every drive you do from your home to a business location is not deductible because it's a personal drive, because you're going from your personal home to a business location. Then business location to business location, those are always business drives. However, once you do the office and home, you unlock that first drive. And when you unlock that first drive, then you are able to take more and lots more business miles, right? Because you're essentially switching a personal mile to a business mile once you have the office and home. So make sure you do that. I'm not going to go into the specifics of office and home. You basically just want to have a dedicated space inside your home. Doesn't mean you have to have the whole room dedicated to your business office. Just have a desk and a chair and say, hey, I'm taking 5 square feet, 10 square feet, something like that. Now, if you have a whole room dedicated to your office, that's great. But if you don't, like, it can't be a dining room table, it has to be a desk with a chair that's kind of offset. You don't have to take the whole room, just take the area that the desk is. All right, couple questions. I'm a new agent, opening a business account recommended. Yes and no. When you try to open a business account, they're probably going to want to see you have a DBA or an LLC or a corporation or something like that. As a new agent, you don't have to do anything like that. So it doesn't necessarily have to be a business account, but if you can open a separate account, that's great, right? So, and if you can have a separate credit card, so if you can have a credit card that's you say, hey, I'm only using this credit card for business transactions, that makes bookkeeping and giving that information to your bookkeeper a whole lot easier. Because if you give your bookkeeper or your tax person, if they also have a bookkeeper, if you give them like all of your personal transactions, and if you just put everything on one debit card or credit card, they've got to sort through and say, hey, I think this is personal and this is business. And you've got to go in and you say, yes, I think that's personal, I think that's business. And you've got to go through and clean all that up. And you're usually doing that under the gun in like February, March, or April. Most real estate agents like to procrastinate and like to wait on this stuff. So most of the time it's done in April. And I see more tax professionals than not just basically say, hey, I'm not even going to help you. Like, you're not organized, you're not a good client for me, I'm just not going to help you. And I'm seeing a lot of tax professionals leave the business, right? And I've gotten more clients and more phone calls recently about, hey, my CPA is retiring, and there's not a lot of people coming into the mix, right? As far as new businesses and startups and things like that. So, yeah, the more organized you can be, the better chance you'll have a good CPA or good tax person that's going to be able to help you out. So yeah, keeping that categorized is really, really important. Ram asks, what about a car purchase 2 years back? Still making payments, but didn't want to expense deductions. Can we still get the depreciation? I mean, if you want to try to do kind of a weird backdoor thing where you might be able to, sell it to someone and then have that person sell it back to you, that might trigger some state income tax or some sales tax on the vehicle. You probably don't want to do that. There might be some workarounds, but as far as the depreciation cost, going back to a vehicle that's 2 years old, you won't be able to do that because it has to be a newly purchased vehicle. It can be new or used. But it has to be newly purchased by you. You can still go back into. Yeah, you can still go back and you can amend returns if you can, say, hey, I want to, take a look at, did I deduct everything that I could deduct? You can go back and amend returns. I don't know if you could amend to include the bonus depreciation. That might be something we can look at if you think that that's a good deduction for you. But yeah, you probably just want to, you know, make sure going forward that you're keeping track of those. Alan asked, can you lease your own car to your corporation? Some cases you can. I usually don't recommend that, but there are some strategies to, you know, giving college students and things like that access to business vehicles, things like that. Claire says, I heard that opening a company like an LLC reduce the income tax. Do you recommend? Not for everyone. Once you cross over like $50,000-$60,000 in profit every year, so if you feel like you're taking out more than $60,000 a year from the business, that's usually when I recommend an LLC or a corporation. And then it has to be an S corporation. And essentially what's happening when you do the S corporation, you're splitting the profits or the take home from your business between business profits and wages. So if you don't do that, if it's just like, you know, Schedule C, the plain vanilla by default, what it is, you're gonna pay self-employment taxes on all the profits from your business. But once you set up the S corporation, it splits that where you can choose how much you pay yourself in wages. There's self-employment taxes on those wages. And then the dividends, distributions, or profits from the S corporation then are not taxed Social Security and Medicare. So that's where the tax savings from the S corporation comes around. There is also some fun stuff that we do with the S corporation as far as tax savings. But for the most part, you're going to want to make sure you're making $50,000, $60,000 or more per year, because there's a lot more administrative tasks. You've got to run payroll and you have to have more cash flow and stuff like that with an S corporation. So that's kind of my rule of thumb, is like $60,000. Craig says, Ram, just buy a new SUV, great deals now. Yeah, maybe. We'll talk about some of the electric vehicles in a little bit too. Rabid asks, do you prefer S corporations, LLC? You know, honestly, I've seen some negative discussions about LLCs for real estate agents. I don't know if I really approve of those or you know, can say either way. I work really closely with a incorporation lawyer based out of Nevada. His name is Scott Burnett. He's really good. He sets up LLCs for real estate agents in California all the time. Although there is some literature from the California Department of Real Estate that says that they don't like real estate agents to be LLCs. So honestly, I've kind of seen stuff back and forth. But I think the easiest thing to do is to set up a corporation and then make that corporation LLC. But you always want to check with an incorporation attorney about the legal implications of doing an LLC or a corporation, because in certain legal situations, those LLCs and corporations work completely different. I'm not going to go to that. I'm not a lawyer. Talk with a lawyer. Romo asked, what about DB plans for IRA income? Yes, Romo, DB plans are a great way to save money on taxes. However, most real estate agents do not do DB plans because it requires multiple years of investments and contractual liabilities, essentially. Because with DB plan, what you're doing is you're setting up a defined benefit plan, which is essentially a pension plan. So most real estate agents, because the market kind of goes up and down, you saw that between 2021 and 2022, you have to contractually say, I'm going to put this much in over a course of 3, 4, or 5 years. So most real estate agents don't like the DB plans. They prefer just to stick with a 401k, things like that, because the DB plan does require more consistency, and real estate agents, unless you are a really established business, really struggle with consistency. Rabit says, my tax guy said S corporation would help a bit more. Yes, as long as it's done properly, and you're doing everything properly within the S corporation. Maria asks, what is the best way to give money back to your buyer from your sales commission and not be liable for taxes? That's a great question. I've actually worked one-on-one with a couple of my clients on that specific question. And it's really different for every situation. Most of the time, it just comes up to biting the tax bullet yourself, because you usually don't want the buyer to have to bite that tax bullet themselves. So usually it's the agent that comes back and has to bite that tax bullet. Okay, cool. All right. So we talked a lot about the questions. Thank you so much for those great questions. I really appreciate
Jake,
that.
I have one. It's just that I don't type in the chat because I do a lot of texting and typing at work. I have a question. So it seems like to me, this is Monique, Lady M. It seems like to me that the huge tax on the vehicle, it seems like it's the weight. Like the truck and the heavy SUV, it seems like you get more of the deduction versus a Toyota or Corolla or Lexus. Is that the situation?
Yeah,
Weight?
100%. So what happened was, this is actually a legacy tax ruling or tax rule back from the Bush days, when they really wanted to encourage, spending more on fossil fuels and gas. So a lot of people nicknamed this the gas guzzler or the Hummer tax loophole. And essentially what they did was they said that a heavy SUV, which is over 6,000 pounds, is considered a business vehicle. And then when it's considered a business vehicle means that you can write off up to the business use of that vehicle. So anything less than 6,000 pounds, they consider a personal vehicle, not a business vehicle, and it doesn't get those same appreciated or accelerated tax benefits. So there's a heavy SUV. There's also a truck, which has a 6-foot bed or longer. So there's some rules on that. So if that's something you want to do, the best thing to do is just go on Google, type in Section 179 or Section 179 plus bonus, and you can learn a lot about how that works and what vehicles qualify for that. What I really like is now with all these electric tax credits that are coming out that are kind of newly reinstated, and there's new ones here for 2023, mixing these two together have a lot of benefits. So in this slide right here, I talk about the Porsche Cayenne Turbo, which is cool because it not only gives you the 6,000 pound heavy SUV accelerated depreciation or bonus depreciation with the 179, but it also gives you that new $7,500 electric vehicle tax credit. So essentially you're maximizing or you're getting two different tax credits with a vehicle like this. I pick on the Porsche Cayenne Turbo here, but you can also do this with the new Ford Lightning that's coming out, which is a truck. If you're like, hey, that's pretty cool, it's an electric truck, you have the ability to do truck or SUV. So yeah, lots of different options here. And again, it's different for everybody. If you don't want to be driving a Porsche, there's some Toyota Highlanders and stuff like that. Again, you can mix and match if you want something electric, if you want something gas guzzler. And again, when I say the gas guzzler, the Hummer SUV, now there's these 6,000 pound SUVs like this one, for instance, is a hybrid, right? So you have the benefits of electric, but then you also have the heavy SUV, which qualifies for those tax breaks. Also, if you're looking back on the slides later with the link that I gave you, I talk about the LLC and the S corporation here. So like, $50,000 cash out every year. That's kind of what I recommend. But if you're not good with paperwork and organization, I have a couple clients that they've already passed over the 60,000. I'm like, you should not do an S corporation because they're just not good with paperwork. They just don't like organization and the paperwork. And I don't feel like that they would understand payroll, right? And paying yourself payroll on a biweekly or monthly situation. It's just not for everybody, right? But most people, if you're over that $60,000, is going to save you some money if you're doing the S corporation, if it's done right, right? That's the critical thing. Let's see, Maria, yeah, section179.org. That's great. I think there's a couple websites too. I don't know if that website has it, but there's a couple websites. If you just type in heavy SUV section 179, actually gives you a list of all the vehicles. And there's also really good lists of the new vehicles that qualify for the electric tax credit. So you can kind of compare those side by side, again, if you want to double dip or get both of those tax credits, which is great. So 2022 taxes, of course, we're getting deep into or deeper into tax season here. So if you have no idea how much you spent in 2022, if you weren't keeping your books, if you're like, I just don't even know where to start, I will jump on a call with you. I normally don't do that. But I will, just because I'm doing a presentation for you guys. And I've been talking with Inturo for a long time and working with you guys and doing presentations with you. And I've got a couple people there at your office that are really good clients. So I just want to encourage that relationship and help you guys out. So if you are just like a complete mess and you're like, Jake, I don't even know where to start, I'll jump on a call with you at no charge. Normally I do $250 an hour, but no charge. And then I'll kind of walk you through what we need to do. And if you've got nothing organized and you're like, I don't even know where to start, you can send me your bank statements and your credit card statements. And what we do is we actually have a system that takes those transactions, categorizes them for you, and then we give you a tax ready P&L. Now you got to review it a little bit, but it's the closest thing to saying, I've got nothing, to, hey, this is pretty cool, in the shortest amount of time at the lowest possible price. So again, I just kind of throw that out if you guys want to do that. So just shoot me an email, jake@adamsabc.com. Or you can go to my website, and then there's an appointment link on there, and you can schedule an appointment with me. I'll be out of town next week for a little snow vacation before I dive really deep into taxes. So there might be some limited availability, but just jump on there. You can book a call with me if you have any questions. Okay, so we talked about that. Now, if you are a Schedule C, right, which is everybody that's not a corporation or an LLC, there's a really important credit you should not miss out. And if you don't know about it, just do a Google search on it, the Form 7202. It's a credit for family leave. And it basically says, if you're taking care of kids while they have COVID, or you had COVID and couldn't go out and work, this is specifically for self-employed people. You can get thousands and thousands of dollars tax credit on your taxes by just saying that you had COVID or that you're taking care of somebody with COVID. Never seen this audited. So, I mean, again, use it responsibly. But this form can literally put, hundreds of thousands of dollars back onto your taxes, or, reduce your taxes if you need it. You can see here, right here, $500 per day, up to 10 days. So that's a tax rate of like up to $5,000. Just right there. Again, use it responsibly. Don't take advantage of it. But if it applies to you, a lot of people are missing out on this tax form. So do some research into it. Talk to your tax professional. If you're using TurboTax or something like that, just type it into the search bar or whatever that it's got on there, and it should be able to walk you through how to fill out this form and getting that on your taxes. Okay, what else we got? Okay, we talked about the vehicles. Now, this happens with a lot of agents. They're not tracking their miles. You don't have to, I'm not going to call anybody out. You don't have to raise your hand or put it in the chat. But if you're not tracking miles, you kind of have to know how many miles you drove in the year. So if you have no idea, absolutely no idea, you haven't been tracking it, haven't been using an app, haven't been keeping a log, that's okay. One of the best things that I recommend is if you use Google, Gmail, or any kind of Google services, search Google Maps timeline in your Gmail. And if you have your location tracking on through Google, which it is by default, it may have been tracking your drives. So even if you have been tracking your drives, Google may have been tracking you. Now, I know that sounds a little big brother, but in this case, it might be kind of nice to say, hey, how many miles did you drive? Now, in this particular situation, it's not going to give you the total for the year. You would either have to personally go through and track all the drives, or have a VA do that for you, which I recommend, someone in the Philippines or in India for, $3, $4, $5, $8 an hour, just going through and doing this. And most people can do that, 8 to 16 hours, depending on how many drives you did. Like I said, you can't export it, but you can see a day-by-day total. So then every single day, someone can basically open up an Excel sheet and then type in the drives, right? Or copy and paste the drives from the Google Maps timeline into Google Sheets or an Excel or something like that. Yeah, and this is essentially what it looks like. So this is my drives from a prior year. You can see I drove up to Chico and Paradise. I was over here in Marin. I was down here in San Jose. I was over here in Sonora, Murphy's area. So you can kind of see, this is essentially Google tracking me as I was driving. I didn't authorize them to track me. It's just, they just do it by default. But like I said, if you aren't tracking your mileage, which most people aren't, this is a great way of doing this. And essentially, you can just click on this guy right here. You can drill down to the month and the day. Like I said, you probably don't want to do this yourself. If you've got a young kid at home, they can do that. If you don't, hire another person's kid, get a VA outside the US, someone like this, and just have them take care of that for you. So you understand and how many miles you have, because the IRS will ask for this if you get audited. And that's their favorite thing to audit on real estate agents, because they know that most agents don't record their miles. Going forward, you're going to want to have an app that's doing that for you. I recommend MileIQ. There's a whole different, a whole number of different apps out there that'll help you with that. Keep track of your mileage, but that's critical to maximizing your tax savings. So if you jumped on this call with the goal of maximizing your tax savings, there is a huge point right there, because you miss out a couple hundred miles, that's a couple $100 in tax deductions. Okay. So a couple other things, how to lower your taxable income. If you got any questions about mileage or tracking, anything like that, you can put that in there, but I don't see anything rolling in. Okay. Okay, so let's talk about a couple of other ways to lower your taxable income. We got income shifting to other people. Paying your kids is a great way of doing that. You can pay your kids up to $1,000 a month or $250 a week. You can get $3,000 in tax savings just right there. Just deposit to your kids' account. One thing that I do for my kids, and I recommend to everyone else too, is to put that money then into a Roth account. Because if you put it into a Roth and, even index ETF funds, whatever, if those are going to grow 5, 8, 10% a year, they could have up to $1 million of complete tax-free money by the time they're 55. And inside a Roth account, you can take that money out at any time for anything. So if they want to use it for school, you can do that. For college, you can do that. For buying a painting, you can do that. For buying a car, for buying a house, for buying a rental property, pretty much anything you want to take that money out from the Roth, you can do that tax-free, or you can set it and forget it, just let it grow. And now with the markets kind of going up, if you've been noticing that over the past couple of days and weeks, I think now is a good time to put more money in, or put some money into the markets as they are kind of coming back from rebound. So it's a good time, and I'm putting my kids' money into Roth accounts and putting that into just kind of like, index ETF funds that are matching the market. Income shifting to yourself in the future. What is that? Retirement, 401k, IRS, SEPs, things like that. I'm not going to go into those. You can do some research on your own for those, but usually I recommend 401ks. They're the most flexible for self-employed people. The other way to lower your taxable income or your tax bill is to buy stuff, right? So if you buy $100,000 worth of stuff, you're going to save $32,000 on average if you're at the 32% bracket in tax savings, right? Do you have to go out and buy $100,000 worth of stuff? Maybe, maybe not. If you can make those investments inside your business and you're going to get a positive ROI on that, then by all means, go ahead and do that. But never spend money just for the tax deduction. Spend money because you're going to get ROI. Spend money because it's going to help your business. Spend money because you're enjoying the trip or the travel or the thing that you're buying. Never buy something just because there's a tax deduction for it. Great example is like pens, right? You could buy a $5 pen versus a $10 pen. Well, if you buy the $10 pen, you're going to get more tax savings from it. But if you don't like the $10 pen any more than the $5, there's no reason to spend more money just because you're going to get more tax deductions for it. It's going to cost you more for that thing because you're spending more money on it. And don't think always about the tax savings. Converting personal expenses to business. There's a huge difference from that. I talked about that. There's a lot of tax credits too, right? So as I'm working with people that are making $250,000 or more in their business, we start to look at things like these additional tax credits, because we're like, hey, we're spending a lot of money on taxes. How do we reduce our taxes? So there's things like R&D credits. There's plug-in electrical vehicle credits, disabled access vehicles. We look at doing solar. A lot of people are just doing solar because it's 30% tax credit. It's been restored for the 2023. Restoring old buildings. I have a couple of people that that's kind of their hobby, is restoring old buildings. So we look for these old buildings that need to be rehabbed, and then there's a lot of tax credits and deductions for those. Hiring vets, homeless people, unemployed people, opportunity zones, the kind of fire and information around the opportunity zones is kind of going away. If you're in it, you're in it. If you're not, there's just not a lot of benefit to it now as opposed to a couple years ago. There's new tax credits for the increasing the electrical efficiency of your home. So if you're not familiar with these, just look up the Inflation Reduction Act. There's going to be credits for your household. So that's electrical appliances, your electrical system, stoves, heat pumps, different types of dryers or dryers that have heat pumps, solar installation, and more. So if you want to do some home remodeling stuff, there's a lot of credits now. But those are very finicky. It depends on your income and your zip code, lots of weird stuff. So I would let the dust settle on that for a couple more months let people understand that, digest that a little bit more as far as what those credits are before you dive in and start, spending a bunch of money on these upgrades, thinking that you're going to get the credit. Make sure you can know that you're going to get the credit if that's the main reason why you're doing it. It's just for the credit. Meals at restaurants, 100% deductible. Talked about that. If you're doing standard deduction on your taxes, make sure to include money for charity if you're donating to charity. If you're putting money for retirement, look for the savers credit if that applies to you. If you set up a new retirement account for your small business, 401k, things like that, there's a credit for the costs if there was any to set that up, which is great. If you're over 70, don't miss your RMDs. That happened to my parents this year, so we had to figure that out, those RMDs. Got some stuff on AB 150. I'm not going to go into that because it's going to sunset in a couple of years anyway. If you're already in the kind of cycle of doing the PTEs or the AB 150s, keep going with it if it's working for you. If it's not, it's really complicated. Then don't even worry about it. Most clients that I have that are making over 150, 200 are going into the PTE, this AB 150, and taking advantage of that tax credit. Like I said, it's really complicated. You need to make sure you pay the right amount of taxes at the right time. There's a lot of communication, a lot of payments, a lot of things, just super complicated. So if you don't know about it, don't worry about it. If you're already doing it. It's going to sunset in a couple of years anyway. So if you haven't been in the cycle, it's not going to be as beneficial to you if you haven't been in a couple of years. Let's see here. I got some important dates. So estimated tax payments, 1099 forms, as corporations, things like that. One of the most important things when you're looking at the tax deadlines, a lot of agents like to extend just to give themselves more time to review the return, do the return, whatnot. Make sure that you at least do some payment. So I try to recommend that you do, as close as you can, your books and your taxes, try to get as close as you can to what you think the taxable income is going to be, figure out the tax on that and pay something. Because and even if it's just to California, like pay California first, IRS later, whatnot. Because anytime that you don't pay, anytime you don't pay before the deadline, which is 4/18, then you're going to get taxed. There's penalties and interest on failure to file, failure to pay, interest payments, things like that. So try to pay what you can, try to do as close as a tax return as you can before that 4/18. Even if you're going to do extension, just pay something because that's going to reduce any kind of interest and payments and penalties and things like that you might have in the future. Yeah, I think that's it. So yeah, any other questions, feel free to shoot that over. I know I'm on a couple minutes over. I'll stay with you guys here for about 10-15 minutes. If you guys have questions, happy to stay on, answer any questions that you guys have. If you have more personal questions or individual questions, you can send that to me at my email address there or schedule that appointment with me. Happy to do that for you. And thanks for the opportunity to talk to you guys. I really appreciate it. Alfredo, do I have you there? Or?
Yeah,
Thank you, Jake. That was
Yeah.
very helpful. Thank you so much.
Yeah,
You're
thank you
welcome.
so much, Jake, for putting this on for our offices, and always a wealth of knowledge here for taxes. So hopefully, if anybody has any extra questions, Jake is gracious enough to set up an appointment with him.
Thanks a lot, Jake.
Thank you, Jake. It was awesome information.
Good.
Hey, Jake, I sent you an email because I couldn't grab that link from the chat. So if you can email me that link for the slide deck, that'd be great.
Yeah.
Awesome.
Thank you, Jake. Appreciate it.
Yeah, thanks, guys.
It was real good. I'll email you because I do have some questions offline, and then maybe we can schedule an appointment to come see you as well.
Sounds good.
Thank you, sir.
You are welcome. Hey, Alfred, I just emailed you that.
Okay, great. Thank you.
Cool. All right, lots of good stuff. I don't see anyone with questions. So if you don't have any questions, I'll just give it another minute just in case anyone has any questions that they're typing in that trickle in. Otherwise, you can feel free to unmute yourself. Alfredo, if you have any closing things, you're welcome to.
Jake, I got a question. Is it better to file quarterly for S Corp or annually?
So when you mentioned filing, the only thing that's required for S corporations to file quarterly is payroll stuff. So when you're an S corporation as an employee, you need to pay yourself wages. So you should have a payroll company like Gusto, ADP, Paychex, whoever, that's taking care of those quarterly filings for your payroll. If you're talking about tax payments, there's no tax payments that are required for the S corporation. There is a end of year payment, which is due 3/15 for California S corporations, which is 1.5% of the profit of the S corporation. It's different for LLCs, but I'm just going to focus on S corporations. So that one you can prepay that early if you're like, hey, I know I'm going to make X amount or whatever. You can prepay some of that if you want, but you don't necessarily have to. The penalty on not prepaying that is pretty low. And then if your question is about your estimated taxes, which are paying portion of your income tax for the year during the year, then yes, you can do that quarterly. I recommend to do that quarterly, but you don't always have to pay it. And most agents choose not to pay that quarterly because the problem is once you put that money in, you can't get it back out. So for example, if you make a $20,000 quarterly estimated tax payment in March, April, and then like you have a downturn in the market, you're like, oh shoot, I need that $20,000, or someone gets sick, or you have a car repair emergency or something like that. And you're like, hey, I really need that $20,000 back. You call the IRS and say, hey, can I have my money back? They laugh at you. They say, no, like we don't do that. So it only costs you about 1 or 2% APR in penalties to hold on to that money or not pay your estimates throughout the year. So most people that are good with their money, I recommend them to not pay estimates because the penalty on that or the cost to hold that cash throughout the year, the benefit of doing that greatly outweighs the cost of that because the cost is only like 1%.
Thank you.
Yeah.
All right, guys. Well, if there's no more questions, we'll go ahead and end the session now. If you have something that pops up, go ahead and there's Jake's email there, and I'll send this out, his information, the slide deck out again to the office. Okay. So thanks again, Jake, for everything. Awesome class today, and we'll talk to you soon.
Cool. Thanks.